Another all-time high on S&P as markets shrug off COVID concerns. China's meltdown continues as the crackdown broadens. Mega cap tech report their earnings and signs of stagflation start to appear. All this and more in this week's Macro Insight. So welcome back to Macro Insight, everyone. Today is the 27th of July, and let's take a look at these markets. Okay, so another one-day sell-off, obviously, early last week, and market reaching as low as around 42.40, just under that actually. That was kind of the spot gamma target level. It was also the 50-day moving average around that level. I think we got to lows of about 42.33 on the S&P. And then, you know, US stocks not only recovered, but they went on to make new all-time highs, as they love to do. Now, according to Data Trek Research, the retail buying, now, you know, they track, obviously, and they've got ways of tracking, you know, what retail people are doing and things like that. And it seemed like retail was buying index exposure rather than single name exposure. And the way you could see that was, if you look at the relative performance of maybe some of the meme stocks and how they've been performing over the last couple of weeks, you know, retail have kind of been getting burnt in that area. So they're looking at the Spiders ETF and just buying that instead. And that seems to be working much better for them, basically, right? So, you know, you look at various Google search trends and things like that indicate, and you look at buy orders for some of these reopening stocks as well, dropping off. And really, it's just all broad-based index buying that kind of drove that rally back up, and a lot of it coming from retail. And we know that the passive kind of wall of passive money, you know, is coming on the broad indices, and that's what's helping keep those tech stocks rallying. Well, that's the same sort of flows that we've been seeing. Okay. So there you see the support held on the S&P. You know, I had a Fibonacci confluence zone at 42.55. Spot gamma had their level at 42.40, and then we had that moving average that's coming in around that level as well, the 50-day, which it kind of loves to bounce off or has a brief little test below, and then often bounces straight back above that, given how strong that trend seems to be still in the S&P. Yeah. So, you know, the concerns, you know, of the Delta variant of COVID were being touted as the reasons for the weakness. You can believe that if you want. I had said that I thought that was unlikely to persist because, you know, we had the UK that was kind of leading on that front, and they were reopening despite the fact we had higher cases. And you know, the reason being is because death rates are what matter more, right? So this chart here shows you okay. So you can see here that total vaccine doses administered, all the various countries, you know, the big sort of developed world countries, let's say, UK's up there at the top with Canada. Then you've had Europe kind of accelerating and the US tailing off a bit. And then obviously got India and Japan quite far behind. But then if we look at the cases versus deaths, whilst the case count has been going up quite dramatically, deaths have gone nowhere, right? So that has been the justification. You know, it's being said that it's the vaccinations that are the reason for that. And so given what's been going on around the rest of the world, the idea is that COVID is not going to massively derail every economy, because you're still going to be able to operate, because the chances are your death rates aren't going to get crazy out of control. Now, in the more developing world, in countries such as Indonesia, apparently it's not quite as rosy. They've only got 10% of their population vaccinated, and, you know, death rates are spiking kind of in line with what cases are doing. So that is a bit of an issue, but in terms of the Western world and the major developed economies, it seems like they've got this stuff under control. And that's certainly what the market seems to feel like, right? So if you look at some of the price action and you look at what happened after the bounce and which sectors were leading the bounce and which kind of asset classes were moving. And if I share this screen, so this chart here kind of shows us. So when we basically got the recovery, you had your sell-off, and you can look at what the main things that sold off were. Obviously, we've got the 10-year yield in green. That obviously yields went lower. Oil got battered down about 8%. All the major sort of indices, Russell, NASDAQ, etc., were down around 3%. And then on the recovery, we see NASDAQ and Russell are pretty much in line, right? So Russell recovering just as well as the NASDAQ, which hadn't happened on the previous sell-off. And then, you've also had copper massively bounce from, copper went down around 3% as well. It's now up 6% from that initial before the sell-off. Oil recovering strongly as well, back to kind of where it was before that weekend sell-off, and yields also recovering as well, right? So pretty broad base in terms of asset classes. If you look at the sector leadership, kind of, again, on the downside, you had XLE, so energy sector, you had metals and mining getting hit. And then on the recovery, metals and mining are now actually in front, right? So strong recovery there. So the actual leadership, if we go off the bottom, is kind of coming from energy, metals and mining, kind of the more reflation type sectors are actually bouncing pretty strongly, as they had been quite beaten down because they were supposedly the most sensitive to COVID concerns. They have also ripped back quite strongly, right? And that's not just in the US. You've also had like the travel and leisure sector index in Europe that I was tracking, SXTP, that's also recovered pretty strongly as well. So a lot of signs that the market is now looking past this COVID variant issue and saying, you know what, UK reopened, their cases are coming down, their deaths never even went up really, where we can deal with it. And that's kind of seems to be the message that the market is kind of giving us. Yeah. Okay. What else is there to talk about? So now the big issue, the big risk is coming out of Asia right now. So China basically are cracking down. We've seen them crack down on, companies that were listing in the US and things like that. That kind of started a few weeks back. But now they're cracking down on education tech companies, right? And they're saying basically they should be non-profit. So any companies or institutions that teach the school curriculum need to go non-profit, and they can't pursue IPOs, and they definitely can't raise foreign capital and things like that. So China very much kind of becoming a bit more isolationist, a bit more with and they're trying to. And the question really is now: is there going to be contagion from that? Because the Chinese equity market is getting absolutely battered, right? So we bring this chart up here. Literally, that's what it's done in the last 3 days, right? So it's a pretty ugly move in China. K-Web ETF, one that I've often showed. If we bring that up here, I mean, you look at what that did sort of last year and even early this year, that accelerated, absolute collapse, right? I mean, it's just, and it's about as oversold as you're going to see, right? It's not often you're going to see RSIs kind of below 20. So, you could argue it's oversold, but the problem with these type of markets is, it is like catching a falling knife. So it's very contrarian to buy it as when it's that oversold, but when often crashes come from oversold conditions, right? And we already it's definitely feeling like a crash already, right? So, had you started to dip your toes in when it went below 30 in the RSI, and then you've seen a very quick 20% sell off in your face, it's often not good advice to be catching a falling knife, right? Each to their own, know what risk you're getting into. We could easily get a 5 to 10% bounce on not a lot. China often do intervene in their equity markets as well, and that triggers a bit of a bounce. But know that if you're playing in this to try and catch a falling knife, you want to be pretty disciplined with your stop, because yes, you might have 5 to 10% fast upside, but you've got that easily on the downside as well, right? So pretty tricky to trade those sort of setups, I would say. Yeah. What else? China, the question really is China now going to sort of crack down on firms like Apple and Tesla, which are kind of heavily reliant on Chinese consumer market to sell their products? So that could be the next stage of what China are up to. And that should maybe provide you some caution in some of those names, basically. JP Morgan have downgraded all of the Chinese kind of tech sector, warning that the weakness is likely not over. So, definitely a cause for concern right now. Doesn't seem to have filtered through to other markets just yet. But often, if you look back at past episodes of Chinese weakness, like 2015 is the one that really springs to mind, that can create some problems, especially if they end up having to kind of devalue their currency or something like that. Yeah. Another point on this is that Cathie Wood's ARK have said that their China tech exposure is close to zero now. And it was as much as 8% of their fund back in February. So they've just got the hell out of there due to the regulatory risk there, basically. Okay. But it's tough to know, really. It's tough to play these things because it's all political and it's all being driven by this authoritarian government, and you just don't really know where this is going to end. Yeah. Now, even if the China collapse doesn't really filter through to other markets and we don't get this kind of broad-based contagion, what I would say is we are entering what is arguably a bit of a soggy patch in terms of seasonality. Yeah. So if you look at this chart here, so that kind of goes back to 1985. It's left out 2008 because that was a bit special. 1985 to 2019, and it's looking at the seasonality and kind of what tends to happen in the main US indices, S&P, Russell, and NASDAQ. And you can kind of see that from January to July, is a relatively nice, orderly kind of upward trend. And you get this soft patch from August through to October, maybe November. And that's what we're about to kind of head into. Yeah. So just purely on seasonality, you shouldn't be overly surprised if the market's going to go a bit sideways and kind of run out of momentum over the next kind of quarter. Yeah. And then, on top of that, you've got some other worrying things going on, right? Global PMIs are definitely stalling. We've kind of talked about that before. You've got goods inflation that may have peaked. Obviously, everyone's thinking inflation's peaked and transitory, but if you look at rents, for example, they generally lag house prices. Yeah. And house prices have absolutely exploded in the US. So there's an argument to say that rents are going to follow that. And whereas your goods inflation might have peaked and starts to come down as commodities have maybe cooled a little bit, and that is debatable because commodities are bouncing now as well. But let's say commodities have kind of stabilized. They're not going crazy. Goods inflation is going to kind of come off a little bit on the back of that. But if rent starts to go up and catch up with house prices, then that's going to take up the slack on what's happening with goods inflation. And so inflation is going to be more sticky than maybe the Fed is kind of saying, right? And I'll keep inflation elevated into next year. And if you look at things like containerized freight, the cost of shipping, that is still staying extremely elevated, right? So no signs of that being transitory for now. Yeah. And so these sort of concerns on inflation not being quite as transitory as first hoped, that's kind of filtering through to inflation breakevens. So the inflation breakevens markets are pushing inflation breakevens up a little bit. And that's resulting in what we see as record lows in real yields. Yeah. So, we've been talking about real yields. Obviously, nominal yields have collapsed recently, but you're seeing record lows in 10-year real yields in the US. Yeah. So, we've seen nominal yields kind of started to kind of come off on the back of inflation being transitory. And then all of a sudden, growth's peaking. Okay, growth doesn't look so good. The reopening's priced in, and now we're seeing a lot of negatives. That was why nominals were going lower. And you would have expected break-evens to kind of follow them lower, but break-evens are stabilizing because we're seeing signs that inflation maybe isn't as transitory as we would like, right? And so those two forces together means that the market's probability of stagflation is increasing, right? So, if price increases had been mainly demand-led, as demand decreases and growth slows down, you should see prices fall. But it looks like, many of the cost pressures from labor shortages, some of the supply chain issues are a bit more persistent, and they could lead to persistent inflation whilst you're getting slowing growth. And that's what we call stagflation. And that's certainly what the move in real yields would suggest is potentially on the horizon, right? So eyes are going to be on the Fed this week or Wednesday, see what their statement, if that says anything about, what they're thinking on inflation. Obviously, Jackson Hole is going to be probably even bigger because they're probably going to need to give us a lot more clarity. This Fed meeting is not going to give us any actual numbers or forecasts. It's just going to be a press conference and a statement. Jackson Hole, you're probably going to get a lot more detail out of, basically. Yeah. And then something interesting that I saw out from Goldmans was that they're kind of downgrading their US growth forecast for next year. And they're often kind of first movers on this type of call. And a lot of other banks kind of tend to follow suit. So here's the kind of charts that kind of stood out for me. And you've got their growth expectations, and they're basically, consensus is kind of bringing obviously growth down into next year, but they're bringing it down faster by a good percent or two for Q3, Q4 next year. And the reasons they're kind of doing that, their main concern is service sector spending remaining depressed for longer due to things like office occupancy remaining low as more remote work is offered by companies, right? So this graph, this sort of histogram here kind of shows you the spending in service categories relative to what it was in February 2020, right? So the bounce back you're getting in some areas is just not as strong as you would like, right? Office occupancy, still 30% of pre-pandemic levels. And the problem with that is, you've got all these kind of office adjacent, you've got an office adjacent economy, right? You've got all these things, and I'll take the quote from what Goldmans was saying, because they say it quite eloquently, right? So greater remote work likely to delay the recovery of office adjacent economy, which implies a lower level of service spending in the near term. Workers who commute to an office, for example, might consume transportation services to and from the office, restaurant meals during lunch, work-appropriate clothing and dry cleaning services, and other goods and services that they pass during their time away from home, right? So if people are just staying at home, yes, they've got to eat, but there's a lot of service spending that they're not doing if they're just working from home. They don't have to buy suits and stuff. They can just sit like me in a t-shirt. It's becoming much more a way of life for people that they know that they can be productive and they can do their job from home quite effectively, right? And something Jim Bianco, for those of you who follow Jim Bianco, something he's been talking about is, people want to go back to baseball games, right? They want to go to bars. They want to socialize. They're not scared of the virus in those terms. But if the virus is giving them an excuse to say, no, I want to work from home because I feel safer, then they're going to take it, basically, right? So there's a change in behavior going on here from the workforce for people who are not forced to come back into the office because it's really important that they're sitting directly with their colleagues. And that's going to have repercussions for the economy longer term. And that's basically why Goldmans are downgrading it for that reason, basically. Yeah. Coming up this week's all about mega cap tech earnings, right? They're going to take center stage. These stocks have rallied very, very strongly. Okay, so you could argue the bar is pretty high for these tech stocks, but that kind of is always the case. Yeah. So let me bring up this chart here. So these are the 1 year performances of some of the big techs like Facebook, Alphabet, so Google and Amazon, right? So you've got the S&P's up 38% on the year. Amazon's a bit under that, but Facebook and Google are absolutely crushing it, right? So they've rallied a lot into earnings, so expectations are already high, but there's not a lot of places to hide, right? Because cyclicals have been rolling over due to growth concerns over the last few months. So people were underweight tech and they've now parked themselves back into tech because that's become a bit of a safe haven, right? And if you look at some of the comps against last year, they should be fairly easy to beat, right? For example, Google and Facebook are big in advertising, right? Should be very easy to beat those comps. And you look at the likes of Twitter and Snapchat have done very, very well on their earnings, right? So that's a little indication that companies that make money from advertising could potentially have done really well in Q2. So let's see that. We'll find that out this week. I think we need to watch the post-earnings price action. Obviously, that gives you, that's really the best way to get a sense of what's priced in. It's very hard to know what's priced in really in terms of positioning, in terms of how balled up people are for these earnings. But I mean, my sense is I probably wouldn't go short into the earnings because these tech stocks just have a habit of just smashing even the highest expectations. So I think the knee-jerk risk of a rally on earnings in some of these tech names is pretty high, especially if retail are like going to chase it and look at their headline numbers and like buy it on that, which we often see that price action. If you want to fade the tech stocks, I would wait for an earnings spike to fade them. Or if you've been long them and you're kind of looking for an exit point, then I'd probably do that. I'd be on the lookout for some strong headline prints that take the stocks up, and then you use that to get out, right? Kind of the whole buy the rumor, sell the fact type price action that we often see on earnings, basically. But the reality is, Tesla beat expectations. Their stocks indicating up a few percent, and these big, despite them being 2 trillion plus market cap companies, they seem to be able to rally quite strongly on earnings every quarter. So I don't see the point in fighting it, to be honest. Yeah. But me, I mean, whatever little Nasdaq scraps that I've managed to pick up, I'm holding them for now with a trailing stop. And yeah, if we get a bit of a pop on the earnings, I might use that to lighten up. Basically, that's kind of the way I'm looking at it. Yeah. But anyway, in terms of what day the earnings are for various companies, on Tuesday you've got Apple, Google, and Microsoft. So that's today. AMD as well. So massive day today. Tomorrow you've got Boeing, Facebook, MasterCard. Thursday you've got Volkswagen, Amazon. Friday you've got ExxonMobil, Chevron, Cat, and BNP. Just some of the big, large caps that are reporting. So it's a huge week for earnings. In terms of macro, the only thing really that matters is probably FOMC on Wednesday to see what they come out with, but we're not expecting much new information out of them. We've got Q2 US GDP estimate on Thursday, and we've got the June PCE inflation on Friday. But like I say, I think macro is going to take a back seat this week. And again, it's going to be all about these mega cap earnings. Yeah. Okay. So that's kind of it on equities. In terms of FX, if we bring up the dollar chart, so we got up to about 93.20. Now it's come back. There's a bit of a kind of channel forming here that it's kind of sitting on the bottom of at the moment. But for me, big supports at 92. It needs to kind of hold above 92 to keep this kind of up move intact on the dollar to then, potentially get a risk of a larger break to the upside. We've got the FOMC meeting this week, so that might give us some color there and might create a bit of volatility there. I do think FX volatility is now getting stupidly low though, right? So I had a look at the FX vol in the euro dollar, and middle of September optionality, close to the money options are on a 5.4 vol, right? Which basically is saying that, if you look at euro dollar, it's sitting on quite an interesting level here, right? So 117, just above 117. I mean, this is a support level here. If that breaks, opens the window up to 114, 115, which is, 3 big figures to the downside. And then if this level holds, you could argue that you've had this big impulse higher, then you have your ABC correction, and then we're heading back to 125, right? Now, I don't know if we manage it in 6 weeks, but the point being that the break evens on like a straddle or a strangle structure to middle of September on this euro dollar look ridiculously low, right? So in terms of risk reward, I don't think it looks too bad actually. If I was going to do anything in FX, it would probably just be buy some sort of long vol strategy to play that this is a bit of an inflection point, and we're either going to bounce and dollar's going to roll over and euro's going to head back up, or you get a break higher in the dollar and then you get, but it just feels like we are at a bit of an inflection in the dollar. Now, whether that gets resolved in the next 6 weeks or not, that's the big question. But that 6 week maturity captures the Fed this week. It captures Jackson Hole at the end of August. So it captures a few potential catalysts. So I don't think it's too bad as a setup. Yeah. In terms of positioning as well, the dollar positioning has kind of lightened up a bit. So there was obviously a fair amount of spec shorts in the dollar. If I share this chart here. So this chart here kind of shows, non-commercial dollar positioning against various other currencies. The black line is kind of the aggregate. So you can see the dollars having reached very short, it's kind of come back to neutral basically, right? So as the dollar's been rallying, it's kind of squeezed a lot of these shorts out. So the positioning is a bit more neutral here. So that's the dollar. On commodities, going on in commodities. So yeah, quite interesting moves in commodities. You obviously had a beat down in oil, strong sell-off, but also a very strong bounce here. So for me, the level, it was a really important level to hold, that 65, 66 area in oil. Yeah, it was kind of this upward sloping trend line. It was also coincident with a bunch of Fibonacci confluence areas. So it held that support, which it needed to hold. Now, if we take the move from the high to that recent low, the kind of last area of Fibonacci resistance is 72.70, 73 area. So that's kind of your main resistance. So if it can get back above that, that opens up room back towards the highs. For now, it's kind of failed that on the first test. But, I scooped up a little bit at 67.5 in oil, running a trailing stop at 70 right now. Happy to kind of let that run, on the upside, not really in a rush to take profit. Obviously, if I get trailed, I'll be out because we could roll back over again and the correction could still be ongoing. But for now, I'm relatively happy with that long and running the trailing stop on it. So that's oil. Copper has been interesting. I had obviously played copper versus gold. I've kind of been stopped out of the copper short on that leg. I've kept the gold for now. So the downtrend was kind of holding copper. It violently broke that, and now it's kind of popped its head up above, even all of the Fibonacci retracements to that sell-off. So copper certainly threatening to go back on the rampage and continue its rally. No point fighting those fundamentals. For me, tactically, it was looking like it was due a pullback, looked like the reflation trade was under pressure, but that price action in copper is pretty strong there. So I've been happy to just kind of get out of the way, basically, on copper. For me, yeah, once it got back above 450, I bailed on the short, basically. I didn't. Now, the infrastructure bill out of the US Congress, they're talking about, making some announcements on that this week. That might bring back some more spec longs. Positioning had lightened up in the spec community in copper. So, maybe we're getting people piling back into that. Maybe that's been part of the move. But yeah, like I say, long term, I've loved copper for a while. So I don't want to sit there with a tactical short on it for too long, especially if it's not working. Yeah. And then lastly, let's look at gold. Gold's a bit of a puzzle to me, to be honest. The resistance zone is still there. Hasn't managed to get above 1830, 1840 area. I mean, real yields at record lows, dollar pulling back, and gold just can't rally, basically, right? So now the last excuse I can give on why that might be the case is that Bitcoin's gone from 29 to like 38,000, right? And obviously we know there's a bit of a negative correlation between Bitcoin and gold. So you could say, in the absence of that Bitcoin move, would we have maybe seen a bit more of a bounce in gold? Possibly. but you know, it's pretty dirty price action from gold, basically, right? So I mean, if you're a short-term bull on gold, that price action is horrible, right? It's got all the excuses to rally, and you just can't manage it, right? So I would be a bit concerned on a short-term long. Longer term, I think you can relax. I think longer term, it's got plenty of time to play out. At some point, it's not going to ignore real yields forever, but for whatever reason, right now, it's just very heavy, right? So that's the way I'd look at it. If you haven't got a massive long-term allocation and you like the gold, you like the story, then it's a good opportunity to get in, right? But on a short-term view, price action is horrible. Yeah, I am long a little bit, like I said, which I bought against the copper, and I've cut the copper short, but I've actually stayed long gold because it just looks a bit too low. But I'm going to run a relatively tight stop on that because, like I say, price action's not confirming the view, so I don't want to get married to that. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.